Imagine convincing the smartest investors on Wall Street to give you $47 billion for a tech company that didn't actually own any tech. This is the story of WeWork and its founder, Adam Neumann. To understand the greatest magic trick in modern finance, you first need to understand how Wall Street values companies. If you start a traditional real estate company, investors will give you a very boring, conservative valuation because real estate is slow. But if you start a tech company in Silicon Valley, investors will write you a blank check. Adam Neumann knew this. WeWork was fundamentally just a real estate company. Their entire business model was signing long-term leases on office buildings, chopping them up, and renting out the desks to freelancers for a short-term markup. That's it. It's an arbitrage game as old as time. But Adam didn't pitch a real estate company. He pitched a physical social network, an operating system for the physical world. And the craziest part, Wall Street believed him. Enter SoftBank, one of the most powerful tech investment funds on earth. Their CEO, Masayoshi Son, met Adam Neumann, told him he wasn't being crazy enough, and casually handed him billions of dollars. With a war chest of cash, WeWork expanded globally at a breakneck speed. But there was a massive $47 billion elephant in the room. WeWork was bleeding cash. You see, renting prime real estate in Manhattan and London is incredibly expensive, and providing your freelance tenants with free beer on tap, kombucha, and arcade games even more expensive. WeWork was losing money on almost every desk they rented. By 2018, they were burning through nearly $2 billion a year. If this were a normal company, the board of directors would have pulled the fire alarm. But Adam Neumann had a secret weapon to hide the losses. He literally invented his own math. In finance, companies use a metric called EBITDA to show profitability. It stands for earnings before interest, taxes, depreciation, and amortization. But normal EBITDA made WeWork look like a dumpster fire. So Adam created a brand new metric for his investors. He called it Community Adjusted EBITDA. Explained like you're five? Community Adjusted EBITDA basically meant taking WeWork's revenue and subtracting almost nothing. They stripped out the cost of marketing, administrative expenses, and most importantly, the actual cost of the real estate itself. It's like saying a lemonade stand is highly profitable as long as you don't count the cost of the lemons, the sugar, the cups, and the stand itself. By using this completely made-up metric, WeWork magically transformed massive catastrophic losses into profitability on paper, and for years they rode this illusion all the way to a $47 billion valuation. But every magic trick has an end. In 2019, WeWork decided to go public. To list on the stock market, a company is legally required to publish an S-1 document, a complete, unfiltered look inside their finances for the Securities and Exchange Commission. No more community-adjusted math, just the cold, hard legal truth. When financial analysts and the public finally read WeWork's S-1, they were horrified. It was a masterpiece of corporate delusion. The document revealed staggering billions in losses, extreme conflicts of interest, and the fact that Adam Neumann had trademarked the word "we" and charged his own company $5.9 million just to use it. Within 30 days, the illusion shattered. Investors pulled out. The IPO was canceled. The company's valuation free fell from $47 billion to the brink of bankruptcy. WeWork fired thousands of employees and became the laughingstock of the financial world. But what happened to Adam Neumann, the architect of this $47 billion disaster? He didn't go to jail. He didn't go broke. To get him to step down and save the company from immediate destruction, SoftBank paid Adam Neumann a golden parachute worth nearly $1 billion. The company collapsed. The employees lost their stock options. But the man who sold the illusion walked away a billionaire, proving one terrifying fact about modern economics. On Wall Street, confidence is just as expensive as reality.